Okay, so we'll continue with problem 5-15. The question here is what amount should be recorded as discount or premium from the issuance of the bonds? If you have read the text class, if the bond is sold or issued at a price other than the face value of the bond, then the bond will be considered as being sold either as a discount or a premium. A bond is considered to be sold at a discount if the price on the bond is lower than the face value. Okay, and then conversely, a bond will be considered to be sold at a premium if the price is greater than the face value. So very simple. If the selling price is lower, then it is at a discount. If the selling price is higher than the face value, then the bond will be considered to be at a premium. Okay. Your account title bonds class bonds payable will be recognized at face value. But as to the amount that will be presented in the statement of financial position, it would be presented net of the unamortized discount or premium. Okay, that is if we are not using the fair value option. But at this point, what is important is that you know that the bond will be considered to be at a discount if it is sold at a price lower than its face value, and it will be considered to be at a premium if it is sold at a price greater than its face value. Okay, and the important takeaway from problem 5-15 would perhaps be the distinction between the price and your cash proceeds, okay, which we will demonstrate here. The company is authorized to issue 5 million pesos of 6% 10-year bonds payable dated July 1, 2022 with interest payments on June 30 and December 31. So this tells us that the bond will pay interest semi-annually, and the payment will happen on June 30 and December 31 of each year. Okay. And second sentence here, when the bonds are issued on November 1, 2022, the entity received cash of 5,150,000, including accrued interest. Okay. Now the face value of the note class is 5 million, while we received 5,150,000 in exchange of the bond. Okay. So one might simply think that perhaps the bond is at a 150,000 premium because we received 5,150,000 when the face value was only 5 million. Okay, but that is not accurate, class, because the 5,150,000 includes your accrued interest. As mentioned earlier, the discount or premium pertains to the difference between the face value and the price. Okay, the 5,150,000 here is not really the price of the bond uh, on its own, but the 5,150,000 already includes the accrued interest. So for us to know at what price the bond was sold or issued, class, we will have to remove the accrued interest component that is included in the amount of money that we have received, in the total amount of cash that we have received. Okay? So you do that by computing for the accrued interest. And you can get the correct answer, you can get the correct amount of accrued interest if you'll be able to compute the correct amount of accrual period. So what would be our accrual period here? Again, the date on the bond was July 1, and it was issued on November 1. By the time it was issued on November 1, wherein we received 5,150,000, there was already interest from July 1 to November 1. Okay. Again, it's very important for you to identify the correct period, class, to compute for interest. Okay, here it's from July to November. So the entire month of July, August, September, and October. So that would be 4 months. So if 4 months have lapsed, how much interest must have been earned by the bond? Okay, so the stated interest rate on the bond is 6%. That is per annum. So you get 6% of 5 million, you would get 300,000. So every year, the bond will result in interest of 300,000 or 150,000 every 6 months. Okay, but since the accrual period, the amount of interest that has accrued as of November 1 was only for 4 months, we will have to compute interest good for 4 months only. So we have already determined that the annual interest is 300,000. So to get the proportionate amount of interest for a 4-month period, you multiply 300,000 with 4 over 12. Okay, and that will give you 100,000. So that means when the bonds were issued on November 1, there was an accrued interest amounting to 100,000, which would have been paid also by the buyer or the holder of the bond. Okay, so if the holder or the buyer of the bond paid 5,150,000, and we already know that 100,000 of that is for accrued interest, then the price on the bond must have been 5,050,000. That is 5,150,000 minus the accrued interest of 100,000. So the price then was 5,050,000, and since we know that the uh, face value of the bond is 5 million, then we would know that the price was greater than the face value by 50,000. And as mentioned earlier, if the price is greater than the face value, then the bond is considered to be issued at a premium. So the answer here would be 50,000 bond premium. Okay, you would have answered D if you did not take into account the fact that the 5,150,000 includes accrued interest. Okay, so this is the distinction, class. Please do not always equate cash receipt, the cash proceeds, with the price on the bond. Okay, the amount of cash that you will receive uh, will not be the same as the price of the bond if ever there is accrued interest. Okay. Proceeding to problem 5-16, what amount should be reported as accrued uh, interest payable? On November 1, 2022, Mason Company issued 4 million of 10-year 8% term bonds payable dated October 1, 2022. The bonds were sold to yield 10% with total proceeds of 3,500,000 plus accrued uh, interest. Interest is paid every April 1 and October 1. Now, although this will not be relevant for this problem, because I want you to see the distinction, because in problem 5-15, the problem tells us that the 5,150,000 is inclusive of the accrued interest. Okay, whereas here, the accrued interest, the problem did not state that the accrued interest is already included in the uh, 3,500,000. It says total proceeds of 3,500,000 plus accrued interest. So to determine that amount of exact total proceeds, you will still have to determine the accrued interest. Now, if interest payments happen on April 1 and October 1, and then the note is dated October 1, and we are currently on November 1, as of November 1, the last payment date must have been, the last interest payment date must have been October 1. And we are currently in November 1. So by November 1, how much interest has accrued from October? So that means the period that we will have to, the question here is as of December 31. Okay, so it will not be from October 1 to November 1. The amount of accrued interest as of December 31 should be counted from October 1 to December 31. So how many months will that be? October, November, and the entire month of December. So that would be good for 3 months. And how much is the stated rate, interest rate in the problem? It's 8%. So 8% times 4 million, you will get 320,000. However, the 320,000 is the expected interest for 1 whole year. But again, as mentioned, the amount of interest that is accrued was only from October 1 to December 31, only good for 3 months. So you multiply 320,000 by 3 over 12, you would get 80,000. Okay. The question would have been different, class, if you were asked how much was the total amount of cash received on November 1. So we would have computed for the accrued interest from October to November. But here the question is for December 31. How much interest is accrued from October 1 to December 31? Okay, next, problem 5-16. 17. What amount of accrued interest payable should be reported on September 30, 2022? Okay, so on January 31, 2022, Bow Company issued 3 million maturity value 12% bonds for 3 million cash. The bonds are dated December 31, 2021 and mature on December 31, 2031. Interest will be paid semi-annually on June 30 and December 31. Now the question is, what amount of accrued interest payable should be reported on September 30, 2022? Again, as I mentioned, the correct identification of the accrual period class is very important to get this right. If we are asked for accrued interest payable as of September 30, so that must mean we are preparing financial statements as of this point. Okay, so as of September 30, how much must have accrued? Okay, so one possible way of one way that students may approach this would be to compute interest from January to September 30. Okay, but that's not correct because whatever interest that might have accrued from January class up to June, that would have already been paid on June 30. Because remember, the interest payment dates are on June 30 and December 31. So even though even though the bonds were already issued, even though the bonds are dated December 31, even though it was issued on January 31, as of September 30, the the accrued interest that is still outstanding will not include those from January to June. Why? What happened to the interest that have accrued from January to June? It was already paid on June 30. So by September 30, the amount of outstanding accrued interest, the remaining accrued interest that is still unpaid, would be from July 1 or the day after June 30 to September 30, okay, the reporting date. So the accrued interest here should only be from July 1 to September 30. Very important that you get the accrual period correctly. Okay. We do not include prior to July 1 because whatever interest that have accrued from those months were already paid by June 30. Therefore, they will no longer remain as part of our accrued interest payable. So we'll only be computing interest from July 1 to September 30, and that would be July, August, September, 3 months. So we'll be computing 3 months worth of interest. The face value here is 3 million, and then the stated rate or the nominal rate or the coupon rate is 12%. You multiply 12% by 3 million, you will get 360,000. Okay, but the 360,000 there is the interest for one whole year. And we are only computing for 3 months from July 1 to September 30. So you multiply 360,000 by 3 over 12, you would get 90,000. Okay, as long as you get the correct period right, class, you would easily get the correct answer. The answer here would be 90,000. Problem 5-18, the question is what amount should be recognized as a gain on redemption of bonds payable? So redemption class, the scenario here is that we will now be redeeming or getting back the bonds that we have issued. Okay, and the only reason the only way that can happen, class, is if we pay for it, class. Okay, remember that the holders of the bonds payable are holding it for the purpose of eventually being paid. So the only reason they will give it back to you, to the entity, would be if you paid for it. Okay, and there will be a lot of considerations as to the amount of redemption price, but that would be more of a concern in your finance classes. For financial accounting class, we expect the redemption price to be given to us. Okay, so the challenge for us now is to know how to account if ever a bonds payable will be redeemed. Okay, so definitely if the bonds payable will be redeemed, it is considered paid for. So the bonds payable, the liability account, should be eliminated. Okay, it should be derecognized. And if ever you will have to recognize any account, class, all related account will also have to be derecognized. Okay, and that includes the discount or the premium on the bonds payable. Again, if we will have to derecognize bonds payable, the related accounts to the bonds payable will also have to be derecognized. Okay, and what are the related accounts to your bonds payable? It will either be your premium on bonds payable and your discount on bonds payable. If you have unamortized bond issuance costs, then that they will also have to be derecognized. Okay, they will also have to be removed. Okay, and whatever is the net amount of the bonds payable class, compared it with the redemption price, compare it with the amount of cash paid to redeem or get back the bond, the difference would be your gain or loss. Okay, if the redemption price is greater if the redemption price is greater than the carrying amount of the bonds payable, then that means you have a loss because you are paying more than your liability. Okay, you're paying more than the book value of your liability. If the redemption price is lesser, if the redemption price is lesser than the carrying amount of the bond, then the transaction will result in a gain on redemption. And you can expect that most problems will give you uh, an instance wherein the transaction will result in a gain class, because for redemption that are at the option of the issuing company, no issuing entity will redeem it at a price greater than the amount it would have paid by the end of the term on the bond. Okay, so if the option is with the issuing entity class, the issuing entity will only exercise the redemption option if the redemption price is lower than the carrying amount, or in some instance, the fair value of the bonds payable. Okay, so the question here is how much is the gain on redemption? So if we will be asked for gain or loss on redemption, we just compare two things: the carrying amount of the bonds payable and the redemption price or the cash payment. Okay. Now, here on June 30, 2022, King Company had outstanding 9% bonds payable with face amount of 5 million and maturing on June 30, 2027. Interest is payable semi-annually every June 30 and uh, June 30 and December 31. On June 30, 2022, after amortization was recorded for the period, the unamortized premium on the bonds payable was 300,000. Okay, so there's premium. So that means the value of the bond is greater than its face value. And how much was the remaining premium? How much was the unamortized premium? It's 300,000. So at this point, the carrying amount then, okay, the book value then of the bonds payable amounts to 5,300,000. So we already have one of the two things that we need. Okay, the carrying amount or the book value of the bond. Next is compare it with the redemption price or the cash payment. On that date, the entity acquired all outstanding bonds payable on the uh, open market at 98 and retired them. Okay, so the redemption price or the uh, reacquisition price is at 98. So you multiply 98% with 5 million, and that will give us 1% is 50, 2% is 100. So you will deduct 100 from 5 million, you would get 4,900,000. So we now have the two things that we need. Okay, 5,300,000 and 4,900,000. The book value was, the carrying amount of the liability was 5,300,000, and we only paid 4,900,000 for it. Okay, so that means we saved up, or we had a gain of 400,000. Okay, 400,000 is simply 5,300,000 minus 4,900,000. 4,900,000 is the redemption price. The 5,300,000 is the carrying amount. Okay, so when you record this class, you do not just recognize the 5 million bonds payable. You also recognize the related premium. Okay, so you will have a debit to bonds payable 5 million. You debit premium 300,000. To the recognized premium class, you will have to debit it because the normal balance of premium is credit. Then you credit the cash of 4,900,000, and the balancing figure will be your gain on loss on redemption amounting to 400,000. Now, not all redemption problems class will be as simple as this one. But why is problem 5-18 very simple or straightforward? Because we were already given the amount of unamortized premium. It was very easy for us to get the carrying amount of the bond as of June 30. Okay. For problems that are somewhat difficult involving redemption class, the challenge there would be on solving for the carrying amount of the bond. Okay, and it's not as the computation of your carrying amount will not be as simple as this one, because the problem will most problems will ask you to compute for yourselves how much is the remaining or the unamortized discount or premium. Okay, but we do not have that challenge here because we were already given the remaining premium as of the redemption date. Okay, but again, you only need two things to determine your gain or loss class: the carrying amount and the carrying amount of the bond and the redemption price. As mentioned earlier, the redemption price will normally be given. The computation of the redemption price will be an issue in finance subjects, but not so much in financial accounting. Okay, you need only two things: carrying amount of the bond and the redemption price. Redemption price will normally be given, so the challenge on us would be to be able to compute for the carrying amount of the bond. Okay, more on this in chapter 6. Problem 5-19, on January 1, 2022, Nilo Company reported bonds payable of 8 million and unamortized discount on bonds payable of 430,000. On January 1, 2022, the entity retired 4 million of the outstanding bonds payable at face amount plus a call premium of 100,000. Okay, so the redemption price is 4 million plus 100,000. So the redemption price is 4,100,000. We already have one of the two things that we need. The only other thing we need is to get the carrying amount of the bond at the time it was redeemed. Okay. But what makes this problem unique is that the only a portion was uh, redeemed class. Specifically, only one half. How did we know? Because the total bonds payable was 8 million, and then we only retired the 4 million, so only one half. Okay. The question now is, what is the carrying amount of this 4 million? Is it just the 4 million? No, because it has a related premium. In this, related discount. In this case, we have a discount. Okay. And a discount is a contra account to the bonds account class. Now, the question is, how much is the carrying amount? Again, we will not be using the 8 million because we only retired the 4 million. So is the carrying amount of the portion that was retired 4 million? The answer is no, because it has a related discount. Now, do we deduct the entire 430,000 discount on the 4 million? No, because the 430,000 discount is for the entire 8 million. So we will also have to recognize only a portion of the related discount. The 430,000 discount is for the entire 8 million. So the proportionate share of the portion that was retired would also be one half. Since we retired one half, then we will also have to retire one half of we will also have to recognize one half of the related discount. Okay, one half of the remaining unamortized discount. So if the 430,000 is for the entire 8 million, the corresponding discount attributable to the 4 million which we are retiring would also be one half, which is 215,000. Okay, so you deduct, we will deduct the 215 because it is a discount. Unlike in the previous problem, the premium of 300,000 was added. Here, the related discount of 215 will be deducted. That will give us the carrying amount of the bond that is to be retired. So 4 million minus 215 will give you 3,785,000. Okay, so that will be the carrying amount that we will be comparing with the redemption price. So 3,785,000 compared with the redemption price of 4,100,000, we will have a difference of 315,000. And in this case, this would be considered as a loss because the price to retire the bond, to recover the bond, was greater than the carrying amount. Okay, so the answer is 315,000, which is 3,785,000 minus 4,100,000. Okay, proceeding to problem 5-20. Okay, again, if we will be using the fair value option class, the problems will be very straightforward. The more troublesome discussion will be on chapter 6, wherein we will be using the amortized cost. We will be using the effective interest method. Okay, here on January 1, 2022, Carmina Company received 5,385,000 for a 5 million face amount, 12% bonds payable, a price that yields 10%. The bonds pay interest semi-annually on June 30 and December 31. The entity elected a fair value option on December 31, 2022. The fair value of the bonds payable is determined to be 5,125,000. Okay. Plus, you have a 10% yield rate here, but this would become relevant class if we are using the effective interest method. Okay, if we're using the fair value option model, the fair value model, we will not be using the yield rate or the effective rate. Okay, for now, set it aside. We will discuss more about effective interest rates or your yield rates when we use the effective interest method. Okay, what amount should be reported as interest expense for 2022? If we're using the fair value option class, the interest expense would simply be the amount of interest that is paid out of the bond based on the stated rate. Okay, so how much is the stated rate? The rate that is stated in the bond, it's 12%. Okay, you multiply the 12% with a face value of 5 million, you will get 600,000, and that will already be your answer. Okay, very, very important distinction class. Interest expense under effective interest method will be based on the yield rate or the effective interest method, but under the fair value option, it will be simply based on the stated rate. What amount should be recognized as a gain or loss from change in fair value in 2022? Now, very important distinction. Under the effective interest method, we use the effective interest method if we are going to subsequently measure the bond at amortized cost. Okay, and we get the subsequent carrying amount by amortizing the premium or the discount. Okay, but under the fair value option class, there will be a restatement on the carrying amount of the bond, similar under the effective interest method, but the basis would be very different. Under the effective interest method, the carrying amount will still change. Okay, but the basis there would be on the amortization of the discount of the premium. Under the fair value option class, the carrying amount would definitely change, but the restatement or the change to the carrying amount of the bond that is measured using the fair value option is based on the fair value as of the reporting date. We will, under the fair value option, we will restate the carrying amount to match its fair value. Okay, so no elaborate computation involved class. If we are given with a fair value as of the reporting date, then that will be the carrying amount. That will be the amount that will be reported in the financial statements as of that date. No elaborate computation needed. You will just have to restate. You will just have to change the amount, the previous carrying amount, to its current fair value, so that will now be the new carrying amount. Okay, so that the carrying amount would reflect the fair value. Okay, we will just have to restate the carrying amount to its fair value, and the fair value will now be the new or subsequent carrying amount. Okay, so second question here: what amount should be recognized as gain or loss from change in fair value in 2022? It would be 260. Why? Because at the start of the year, it will be initially recorded at 5,385,000. Okay, but its carrying amount as of the end of the year should match its fair value. And how much is the fair value of the bond on December 31, 2022? It would be 5,125,000. So we will have to bring down the carrying amount of the bond from 5,385,000 to 5,125,000. How much is the difference between 5,385,000 and 5,125,000? That would be 260,000. Now the question is this a gain or a loss? Obviously, this is a gain. How do we know that it's a gain? Just think of it that on January 1, 2022, the initial carrying amount was 5,385,000. That means on January 1, your liability was at 5,385,000. But on December 31, it should be changed to its fair value. And how much is the fair value of December 31? It's 5,125,000, meaning your liability has gone smaller. So if your liability goes down, then that will result in a gain. That is considered a gain on your part. Okay, if your liability goes down without any other change to your assets and liabilities or equity accounts, then that will be uh, considered as a gain. Okay, so again, the answer here is simply the difference between the initial carrying amount of 5,385,000 and the subsequent carrying amount of 5,125,000, or a difference of 260,000. Okay, if liability goes down, that means you will have a gain. If liability goes up, then that will be a loss. Okay, and we have essentially answered number 3. What is the carrying amount of the bonds payable? Again, the carrying amount on any given date should simply be the fair value on that particular date. So the answer here in number 3 would be 5,125,000. Okay, let's proceed to problem 5-21. Somewhat similar to the previous problem. What amount should be reported as interest expense? Okay, here the bond has a face amount of 8 million and the stated rate of 10%. And those are the two things we need to get our interest expense if the fair value option method is used. Okay, and which is exactly what is being used in this problem. So we simply multiply 8 million and 10%, we would get 800,000. So the answer in number 1 would be 800,000. What amount of gain or loss should be recognized for 2022 to conform with the fair value option? Okay, it was issued on January 1, 2022 class at 95. Okay, so that should give us the fair value as of that date, because that's the price it was being sold on that date. Okay, so get 95% of 8 million, you would get, I think that would be 7,600,000. Let me just 95 times 8 million. So that would be 7,600,000. Okay, and then by December 31, its fair value was 105, so that would make it 8,400,000. Okay, so the difference there is 8,400,000 minus 7,600,000. That will give 8,400,000 minus 7,600,000. That will give us 800,000. But the problem here, class, is that there's an additional information given here that it is reliably determined that the fair value increase comprised 150,000 attributable to credit risk and the remainder attributable to change in the market interest rate. So the total change is 800, class, but the total change of 800,000 can be broken down into 150,000 attributable to credit risk and the remaining 650 attributable to changes in the fair value. So the answer here will not be 800, but instead it will just be 650. But you would ask, what will be our answer in number 3? What is the carrying amount of the bonds payable? The answer here would simply be the fair value in that date, which is 8,400,000. So you would ask, if the fair value or the carrying amount on that date is 8,400,000 and its previous carrying amount was 7,600,000, but the amount of loss that we recognized was only 650, how do we reconcile this one? Okay, you would say there's a short of 150,000. Okay, that's not necessarily correct. Okay, even though the loss that we have recognized due to change in fair value is only 650, the 150,000 discrepancy here will still be recognized also. Okay, it will be recognized separately. Okay, and it's very important to distinguish it, class, because losses here or changes here due to credit risk is a component of your other comprehensive income. Okay, this will go to your other comprehensive income. I hope you can still remember the items that are considered as part or components of your other comprehensive income. So from 7,600,000, there's an increase in fair value of 650 plus additional increase of 150. thereby resulting in a total fair value of 8,400,000. Okay. So the fair value, the carrying amount would just simply be the fair value plus. But as to the difference, we are now splitting the difference between the amount attributable to changes in market conditions and those based on credit risk. Okay, gain or loss based on change in credit risk goes to your other comprehensive income. Here we have 5-22. Uh, Easycal Company received 1,077,200 for 12% bonds payable with face amount of 1 million. The bonds were sold to yield 10%. Interest is payable semi-annually every January 1 and July 1. The entity elected a fair value option for measuring financial liabilities. On December 31, 2022, the fair value of the bonds payable is 1,064,600. The change in fair value of the bonds payable is attributable to market factors. What is the carrying amount of the bonds payable on January 1, 2022? Answer here is simply the price as of that date, which is 1,077,200. Second question, what amount should be reported as interest expense? Again, interest expense under the fair value option would simply be your stated rate multiplied with the face amount. Since the stated rate is 12% and the face amount is 1 million, you will have 120,000 as your interest expense. Okay, number 3, what amount should be reported as gain or loss from change in fair value of the bonds payable? Again, just compare this one with the previous carrying amount with the carrying amount as of the end of 2022. And based on the problem, it is 1 million. The carrying amount on December 31, 2022 should be 1,064,600 since that is the fair value on that day. And you compare that with the previous carrying amount of 1,077,200, you will get a difference of 1064.6. You will have a difference of 12,600. Okay, there is no mention of credit risk here. Okay, so there's no need to split the amount of difference. Now the question is the change of 12,600 a gain or a loss? Definitely, this will be considered as a gain because the amount of liability went down from 1,077,200. It went down to 1,064,600. So in this case, we will have a gain of 12,600. Now, the last question is, what is the carrying amount of bonds payable on December 31, 2022? The answer would be 1,064,600, which is simply the fair value on that date. Okay. Let's try to go over the. I'll try. I'll just give you the answer some other time.